Mike, do you think the market is overreacting a little bit to what was still a dovish hike, and that ultimately was what the market wanted to see?
You know, I would say it was overreacting, except for the fact, and as I said, for 2 days, the market was so primed to rally just because it was so oversold. And in theory, it could have taken almost any excuse to do that rally, and it didn't. What that tells you is the market was that much more fragile, the downtrend is that much stronger, and it felt itself that much more in need of rescue by an overwhelming dovish message instead of just a moderately incremental move toward the dovish side from the Fed. So to me, the takeaway is this is a market that yet again has declined to take a very perfectly plausible excuse to rebound. And it's been doing this for 3 months.
You use the word rescue, which is interesting.
Yeah.
I mean, maybe it's just that investors are seeing something down the road in the global economy trickling into the U.S. economy that looks negative and scary.
Yes.
and is causing this kind of reaction. And the fact that the Fed chairman didn't really seem to process that or see that.
Yes, he didn't nod in that direction
alarming.
At all, clearly enough. And I do think there's a little bit of a mismatch between the Fed's mandate and the things it focuses on, which is employment and is domestic inflation, and the sources of S&P 500 earnings and the liquidity conditions in equity and corporate bond markets. I mean, all those things I think are a little bit separate spheres.
So
and
who's
you're
usually
right. I think they can both be right. You can have a decent domestic economic situation and not have the market positioned to capitalize on that.
Paul, is one of the factors here that the market is looking, whether it's a year or a matter of months, further ahead than the Fed is? And is that a mistake that the chair is potentially making, that he's not looking further enough ahead?
What was that to me?
It was, Paul. Please go on.
No, I think that Mr. Powell did a really fine job of threading the needle, as everyone was talking about. The fact that the market sold off, the stock market sold off, tells us about the mood of the stock market. But as an economic matter, I think that Mr. Powell did a really fine job. He said that we've arrived at the bottom of the range for neutral, which has been a long-term objective of the Fed for the last 3 years. And that they've achieved it. It's the bottom of the range, to be sure. They brought down the median of the range to 2.8 from 3, so they're almost finished. And I think what Steve Leisman was saying was right, is the market wanted to hear we're finished, and he didn't say that because he doesn't know that they're finished. So overall, I think that Mr. Powell was taking a very sensible position, and I don't think there was any incongruency between where my outlook is and his outlook is from the standpoint of the longer term. They're basically finished the normalization process, and now they're getting back to old-fashioned monetary policy.
Except, Paul, I wonder if the market reaction would have been less severe if we heard things like all options are on the table, including, quantitative tightening and looking at the speed and the size at which we're doing that. All options are on the table. We're going to monitor the data. We're going to monitor the incoming volatility and see if what the market is expecting may be more accurate than what the data is showing us right now. A little bit more, giving more and sounding a little less aggressive when it comes to raising interest rates and sticking with the tightening.
I think he probably could have come up with friendlier rhetoric if he wanted to, but I don't point a finger at him for not doing so. I thought it was very friendly rhetoric, and I don't think he should be in the business of, quote unquote, rescuing the market unless the market gives you a sense that something negative is going to be happening on the economy. And he's watchful about that, but there's no smoking gun that the economy is getting ready to go off a cliff or anything. And I think also in the back of his mind, he wants Wall Street to grow up after 10 years of super accommodation and recognize that the Fed is not Bank of Dad and quit asking for money.
Victoria Fernandez, are you buying anything given this further pullback that we're seeing right now?
We didn't make any changes in our strategy today based on what we saw, but But we've been talking about this with our clients since the last meeting and really saying that we thought the risk was going to be that this was going to be a more hawkish meeting than what the market was anticipating, and that's exactly what we've seen. So looking longer term, I mean, we see the Fed is still expecting a couple more rate hikes next year. That follows along with our anticipation as well. They see that the economy is going to be strong. They said growth greater than 2% till 2021, unemployment rate continuing to come down. So taking a more longer term perspective, we remain a little bit short duration on our investments on the fixed income side. We're fully invested on the equity side and just looking more long term at where we think we'll find some opportunity, but not making changes today based on what we saw.
Neil Hennessy, your own take in terms of the size of this pullback and whether it's a buying opportunity for U.S. equities?
I think it's a buying opportunity, certainly. I had a chuckle when news came out at 11 o'clock Pacific time. By 11:04, the market had gone from up 260 points down to over 400 or down to even, and then went back up 100 and closed down 350. It's just crazy. The reality of this situation is everybody knew we were going to get a rate hike. Did it matter if it was today or if it was going to be the first quarter or second quarter? We all knew that was coming. So what essentially is happening out there is you get people that start to sell, and that's the problem when you get all the money over on the passive side and in these ETFs, is once the selling starts, you can't stop it because everything's going in as market orders. But everybody knew what Powell was going to do and the committee was going to do, so it wasn't a shocker. So here now I look at the market at 15 times earnings, a 2.5% dividend yield, which is a half or 50 basis points away from a 30-year T-bill. You'd be crazy not to be buying into this marketplace because the economy, as Powell was trying to say, is in very good shape.